Welcome to the daily update, where I'll go over the action in the market for Friday, July 26th, and then we'll see how things look for Monday, July 29th. Had a pretty significant bounce. Not an awful lot of action in Friday's session. Most of it came while the market was closed. We saw the futures just grind their way higher, and we added to that in the session, and we were up over 1%. It really hasn't changed the picture other than we're still negative in the short term. We have recaptured the 50-day moving average in the intermediate term, and we're still positive in the long term. But when we go through and look at our indicators, really, other than working off some of this extreme negative condition that we've been seeing, not an awful lot has changed. So let's go back and talk about things after I give an announcement here about the SPXInvesting Program. There are links below this video that talk about the program and can take you to the website. And here's an email if you want to contact me further about that. Also, the daily video is the central figure in all of the videos that I put out each week. Now, this being the weekend, I will be putting out the other videos around the circle. So what happened? We did have a gap higher open and prices climbed above R1 at 54.64. We hit resistance. This is always kind of interesting at yesterday's R1 at 54.83. We didn't really hit any resistance as far as the intraday chart for Friday, but it was the same level that was hit on Thursday. Then we declined back below R1 and we just chopped sideways and we closed slightly below R1. So we were still up 1.11% on above average volume. It wasn't a huge pickup in volume, but it was enough to be above average. So as I stated earlier, we are still negative in the short term. We're mixed right now at best, negative at worst in the intermediate term, but we're still positive in the long term. And all the different geopolitical things, a lot of the political things going on specifically in the US, but there's other things going on in the world that might have an impact on the markets. Some comments. We did see a broad market advance. So pretty much everything was green. It was considered a pretty positive day. We now are above the 50-period moving averages with the S&P. And our list is a little bit shorter here on a short-term basis with those things that are oversold or extreme negative. We have the Stochc RSI, the CCI 14 N20, as well as the stochastics. And the Chaikin oscillator, that's one of our smart money indicators, is still extreme. And then this should be extreme oversold, where the overbought indicator is the 10-period moving average of the new highs and new lows for the S&P. And then on a long-term basis, we have both our 150 and 200 period moving averages are looking extreme positive there. Really no change. There's some talk now about maybe a 50 basis point cut in September. And that's pure well, all of this is speculation, but it looks like the market anyway is anticipating a rate cut. Now, the Fed's going to be meeting in the upcoming week, and there's pretty much all probabilities are that there will not be a rate cut at the meeting coming up. But the market's really going to be tuned into what do they say, how do they say it, the press conference that comes after that, the little book that they come out with, their dot plotter book. So the market's really going to be looking into that. And we have a pretty hefty week of economic reports coming out in the upcoming week as well. The dollar was down and interest rates were also down. We closed at 4.2% for the 10-year yield, where we had been at 4.26%. We're still inverted with the yield curves. Sentiment is back to neutral at 45, where it had been at 39. We're still negative with our trend. The ADX is weakening, but we have the red line on top now. And with the up day, the bias is positive and the momentum, I'm still keeping that at negative for right now. We've seen some pretty solid downward moves. You could make a case that maybe we're mixed because of the solid up day that we saw on Friday. We did get some economic reports. Personal income came in up 0.2%, which was half of what was expected at 0.4%. Last time it was up 0.4%. Spending was up 0.3% as expected and down from the 0.4% we saw last time. PCE prices were up 0.1% as expected, where last time they were unchanged. This was the big inflation part. The core PCE was up 0.2% as expected and up from the 0.1% from last time. Consumer sentiment came in at 66.4, a little bit up from the 66 that they had expected and up from the prior reading that we got in the preliminary report. So here are some charts. Personal income and spending year over year, where we see income pretty much flat. That's the yellow line. And spending is up a little bit more, but also pretty much flat right now. And then the core inflation year over year, it did tick up just a little bit when you annualize this out. And month over month, the spending did decline. And then looking at the consumer sentiment here, the main report is the blue line, which is kind of in the middle right here. And we're seeing a bit of a decline now with the expectations. That's how folks are feeling about things right now. And I'm sorry, in the future. And then the purple line is how folks are feeling right now in the present. A lot of uncertainty going on, especially politically. And no matter what we're told by politicians, folks are struggling with the economy right now. As I always say, there's the Wall Street economy, and they're all happy with that. But then there's real life economy, and some folks are having some difficult times and not necessarily feeling good about things. Here is consumer sentiment, where we came in at 66.4. We have been dropping off a little bit as there's been a little bit more concern about things as of late. And then looking at the top 10 mega caps as a percent of the S&P 500, it's 37.38%. That's the big red area. And then you have all the rest of the companies that make up all of the S&P together. Stocks rarely peak in July. Okay, well, they have since 1950 three times, but where stocks typically will peak is in December. So we'll have to see how that plays out. And the equity flows, we are seeing not as much money coming in now, but the 12-week moving average continues to go up as folks are just throwing money into the market. And the core PCE simulations, this is when we get the monthly report. And then how does that translate out here on a chart where we're below the 3%, but some of these are actually starting to go back up in what they're looking like. But we're still above the green dash line, which is the 2%. That's what the Fed is trying to get down to. And small caps remain historically cheap when you compare them to large caps. So even though we're coming down to really low valuation levels, when you compare them with each other, it should be on a price basis, not so much a valuation basis. But we follow this chart ourselves, and even though we're seeing small caps in favor at this time, when you look at this in a bigger picture, they still have a long ways to go to get back up to the average. Investment grade bonds, the spread, according to Goldman Sachs, they see pretty much things staying flat from here. That means they're not seeing an awful lot of risk right now. And then the U.S. valuations with a combined PE ratio. This is when you take the top-down charts here, and we look at the really big companies here, technology, media, and communications. This is the blue line here, and this is where a lot of the valuation and the PE ratio and overvaluation and stock market real movement is coming from. And then you take those areas out, and this is what the rest of the market is actually looking like on a valuation basis. And I'll be going over this in the weekly video where we look at PE ratios, both historical and looking forward. And then China's relative performance against emerging markets is correlated well with Trump's implied winning probability in the prediction market in the latest episode. I'm not sure how relevant this is. You're taking China, emerging markets, and comparing it with a U.S. presidential candidate. Okay, fine. People actually sit around in a room and think this stuff up, which is kind of interesting. Okay, didn't really spend any time on Twitter, so I don't really have anything to show there. Here is the intraday chart where we saw the real rundown in Thursday's session. Well, because of the sell-off going into the close, we had the gap really wasn't all that much, but it was well off of the close that we saw on Thursday. So that gave us the gap higher open. We were able to drip up above R1, and then you can see we pretty much got back to the Thursday's high. And then we saw some kind of sell program or something come into the market, knocked us back down to R1. We just kind of chopped around below R1 and closed slightly below R1. Our intraday chart, where a lot of the strength that we saw did come in the overnight session before the market even opened up. And we are still seeing where value is outperforming growth. The red line is above the blue line here on the intraday chart. You would think on the up day that we saw that growth would be doing better. And it started off doing better, but it didn't end by doing better on the intraday chart. So we're still going down here with our growth to value ratios. When we look at our end of day charts, growth was up, but quite a bit less for the large caps when compared to value. They were exactly the same with the mid caps and down a little bit less with the small caps. So really no improvement here with our growth to value ratios with the small caps, mid caps, and even the S&P. And when we look at the growth to value ETFs, we're still coming down further into the rainbow. Discretionary to staples, not really much of a change here. We're still below this moving average with the ratio here. Large cap growth saw a nice little bounce, but still remain under the 50-period moving average. And when we look at the ratio between large caps and small caps, it continues to fall as, well, actually it ticked down just a little bit as the small caps are seeing more favor right now. And the Wilshire was able to get back above its 50-day moving average. So this is one broad market measure that we look at that had slipped below the 50-period moving average. Well, now it's back above. And our trend is still negative. Even though the red line came down, it's on top. The ADX is declining, suggesting a weakening trend. In the short term, also, the red line came down, a weakening trend, but we default to negative both in the short and intermediate term, according to this chart. And we're slightly above average with volume, and we've been so over the last few days. But typically what we'll see is a real drop-off in volume in July and August on the NYSE as well as the NASDAQ. But lately, we've kind of been going against that. We're still seeing an increase with the Ulcer Index as fear has been increasing as the S&P has been under pressure. We came down with the VIX on the line chart. We were really starting to spike up there, but we closed a little bit lower, and even the bar ended up coming down from higher levels than what we've been at. And when we have an up day like we had, the VIX of the VIX also fell with the bar chart and the line chart. But the momentum of the VIX continues to be up. And this is historically what we often see with the VIX, and that's kind of what's been playing out now. The equity put call daily chart did decline, but we're still going up with the 5-day chart and the 10-day chart, and that tends to be more negative for stocks. The volatility risk premium, we've come back up into the mid part of this range right now, and we declined with this fear gauge, and we declined with the other fear gauge since we saw more broad market positive action on Friday. And we're coming down. Actually, we ticked up just a little bit, but we're coming down to the bottom end of this range that we've been in 2024 when we look at the risk on versus risk off ratio, but it did tick up just a little bit on Friday. And we're hanging in there pretty good with the advanced decline line based on price, turning back up slightly based on volume, but volume has been actually leading the way lower or underperforming on up days, depending on your perspective. We did see a drop-off in the new highs from the previous day, but they're still expanding, but we're starting to roll over with our 5-period and our 10-period moving average. We're still positive when we look at the advanced decline line, both with the 19 and 39 period. And we're no longer extreme with accumulation distribution. We had enough of an uptick to move the boom indicator out of being extreme negative. But we're still negative here with the Chaikin money flow. It continues to decline, and that is one of the reasons we're still maintaining more of a negative stance on things. And the Chaikin oscillator, even with the update, continues to be extreme negative. When we look at the cumulative NYSE advanced decline line, we went up here We also saw a bit of a bounce up with our regular NYSE advanced decline line and the other NYSE advanced decline line. When we look at the NYSE common stock based on price, saw a nice little tick up here, but less of a tick based on volume. And the S&P advanced decline line based on price on a cumulative basis ticked up here, but ticked up a little bit less based on volume. We're watching this little bit of a discrepancy or lagging when we compare price to volume. Now, some of that can be explained because a lot of the volume goes into the mega caps, and if we're not really seeing that, that could be more negative for the market. And then looking at the NYSE advanced decline line, it's actually holding up better than the S&P has been lately. And our advanced decline line studies going up with the NYSE common stock, even the S&P did advance mid caps and small caps. So we're looking okay when we look at the broad market. It's the mega caps that we're keeping an eye on to see if there's more selling coming from them. Our short-term chart, we did bounce up off of the 50-day moving average, or we didn't bounce. We actually were able to get back above it, and we were just barely above the moving average with volume. And we might have overdone it on a one-day basis. From Thursday to Friday, we're up above this blue line. Doesn't mean we'll reverse, but a lot of times this means short-term exhaustion. The Stochk RSI is still extreme negative. The Williams percent R is no longer extreme negative, but coming up out of that. The CCI 14 is extreme negative, as is the CCI 20. And we're still below the double and triple exponential moving averages based on 20 periods. They're starting to come down. This is still showing that there's some weakness and concerns with the short term. But we went back up with our 20, 50, and 200 period moving averages on the S&P. The force index, which had really been screaming down, did see a bit of a bounce, but it's still negative. We turned back up with the short-term stochastic. We're still extreme negative with the intermediate short-term and declining below the midpoint with the long short-term stochastics. And we're below the 20-period moving averages, and now the lines continue to roll over here. We wore off this -2. We weren't extreme, so we weren't looking extreme negative here with the standard deviations chart, but we saw enough of a bounce to get into the -1 channel. And looking at the balance of power, we ticked up, but we're still negative. We're negative with the go, no go with the brown bars. And the highest high value, we're now dancing around the lowest low value, which is the red line, and the midpoint is starting to roll over. The TTM squeeze continues to be negative. And looking at our double and triple exponential moving averages based on 50 periods, the red line is starting to come down to the blue line now. That could be adding a little bit more weakness to the intermediate term, even with the bounce that we saw. And we're a little bit above the 50-period moving averages here. So we're keeping an eye on the 100s. If we see more weakness here, we may come down and test these levels. The ease of movement is still negative. The Erin is still negative. We turned back slightly positive here with the McClellan oscillator for the S&P. We had dropped below zero. Well, after Friday, we crossed back above zero. So we're starting to go back up based on price, but we're still declining based on volume. So we're seeing some contradiction here. And we turned back positive with the NYSE McClellan oscillator, back above zero. So we're just kind of chopping around right now with the summation index based on price, and we actually advanced slightly based on volume. And here's another contradiction. We're back above zero with the Swenlin trading oscillator based on price. We're still below zero based on volume. But the momentum continues to be negative with the PMO declining. We haven't quite crossed over with price, but we're crossing over and looking more negative based on volume. So a little bit of an improvement with the PMOs that are rising, but the buy signals are declining, and we turned up slightly with the PMOs that are above zero. And we've gone from being negative to neutral with the Elders Impulse system for the S&P. We're still negative with the parabolic SAR. We're declining with our short-term slope oscillator. The MACD continues to decline. So all of our oscillators on all the different time frames continue to be negative. And we're just a little bit above the 50-period moving average now when we look at our moving average tree chart. And the bullish percent index still holding up fairly well. It did advance after it had been declining, and we're above 50. So this is actually positive. And we're looking positive here with the NYSE bullish percent index. It's actually looking stronger than the S&P currently. But when we look at the NASDAQ 100 bullish percent index, this continues to decline and is negative. The money flow was pretty much unchanged and still positive, where the ultimate oscillator, after being extreme negative, is now bounced back up, but is still negative. We have the red line on top with the vortex, so this is still negative. And we're below 50 with the RSI 14 and 9, even though both did bounce. We're still looking pretty strong here with standard deviation. That just means that we've been moving pretty quickly over the last 10 periods. And we're still above the moving average with on-balance volume. And we saw a bit of an improvement here with those stocks above their 20-period moving averages. And this is still positive since it's above 50. We also ticked back up here with the study that we've been following. We're looking positive with those stocks above their 50-period moving average, 100-period moving average, and 200-period moving average. But on a momentum basis, the Copic curve continues to decline, and the Pring bottom fisher just generated a buy signal recently. This has been acting weird lately. We're turning back up, but still more neutral with the Sean trend meter. And looking at our Ichimoku cloud full study, we're still above the green cloud. So that's not necessarily an area of support. What I'm following here is the blue line is crossing below the red line, and the green line had been declining, but it ticked up just slightly in Friday's session. We're still looking okay here with a 5-period moving average of the highs minus the lows across the broad market. We're above zero. And we are right on the R2 line. Well, okay, we closed at 54.59, where this line here is at 54.51. So we're, what, a point and a half underneath it right now. But you could say pretty much right on the R2 level. So this looks to be holding up as far as support in our longer term chart here, but we're still below the mini rainbow, and the lines are now starting to roll over a bit. Here's the Ichimoku cloud, just using it as support. We're still slightly above the green cloud. And look, keeping an eye on the fib retracement levels, we're still far above this 38.2% retracement. We're still above the 38.2 extension, looking at this chart. And we're seeing a bit of a mixed picture here. We're negative with the Heiken Ashi, where we're negative but pointing up with the Kegi chart. We're negative with the Renko chart, and we're negative with the 3-line break chart. So even with the bounce up, it really hasn't changed anything. The Heiken Ashi is looking less negative, I guess you could say. And we're coming back up above this red line with our 150, and we're turning back up above this red line with our 200-period moving averages. And we're still up here in the pretty extreme reading. It's coming down. We're right on the border here with our 10-day average of the S&P highs minus the lows. And we're still negative with the S&P and the NASDAQ 100 in the short term. These are the mega caps that have been under pressure, where all of the rest of the time frames and indexes are positive. We're negative in the short term with stocks, negative with bonds in the long term, negative with commodities in the short and intermediate term, also the same with the dollar, negative in the short and intermediate term. I finally updated this here, where we're short, or we're negative here with the trend model with the decision point scorecard, and saw some red and then some blue and then some red again here, as really the NASDAQ was chopping above and below different levels. And all of the indexes ended up being positive, with communication coming in first, with industrials, and even real estate had a pretty good day. Energy was up, but was up the least. And we're still looking positive here with the NYSE new highs minus the new lows. We're above zero with the raw score. And the equal weight is holding up a bit better now than the S&P. So we're continuing to decline with our ratio. When this is going down, that means the equal weight is outperforming. The Dow was able to get back above this pivot point and is above its 50-day moving average. We have gone from being negative to positive with the Dow when looking at the Elders Impulse system. We're still below this pivot point and still below the 50-day moving average with the NASDAQ. And also, we bounced up off of this pivot point, but we're still below the 50-day moving average in this pivot with the NASDAQ 100, where we've gone from being negative to neutral now with the Elders Impulse system for the Qs. But the momentum for the NASDAQ 100 continues to be negative, and we're still below this 23.6 extension level here. We've been giving some of that back as of late. The Qs are still below both their 20 and 50 period moving averages. And so we're just watching these different fib extension. Actually, okay, these should be Fibonacci. Okay, disregard this chart. This was some playing around I did where I thought it was coming up with something different. And the small caps were up 1.81%, but we haven't been able to break out above these previous highs yet. But overall, they're holding on to this. We'll have to see. Are we going to turn and then start to go down, or are we going to be able to build upon these gains? And then we've gone from neutral to positive with the Elder's Impulse system for the small caps. When we look at the Russell 2000 small caps, going back up with the RSI above the 50 period moving average, and the momentum is still positive. And we're seeing an improvement here, but longer term, it's still negative when we do a ratio between small caps and the S&P. The mid caps are slightly above this pivot point, still above their 50-day moving average, and have gone from neutral to positive with the Elder's Impulse system, bouncing up a bit off of the 50-day moving average with our total U.S. stock ETF. Apple was up 0.22%, and it's been pulling back, but it's still above its 50-day moving average. And we're just about ready to see a golden cross here with Tesla. It was down 0.2%, though, but it's still above both of the moving average lines. And NVIDIA did go up 0.69%, but still below its 50-day moving average. Microsoft was up 1.64, but underneath its 50-day moving average. Meta was up 2.71% and kind of in between its 50 and 200-day moving averages. Amazon was up 1.47%, but still below its 50-day moving average. Google was down 0.17% and is below its 50-day moving average. And Netflix was down almost 0.5% and below its 50-day moving average. Blah, blah, blah. The FANG index did bounce up 0.2%, but still below its 50-day moving average. And the staples to tech ratio, we're still going up here, but we're below this 200-day moving average. But overall, the ratio has been declining. To turn more positive, we want to see this ratio go down and continue to go down. The financial sector was up over 1.5% and is still looking pretty solid. The bank ETF was up another 1.63%, looking pretty good. The financials are looking better, but still negative when compared to the S&P 500. And the regional banks are showing a little bit of strength here, but still negative when we compare it to the financial sector. The dollar is still in an uptrend for right now, even though it was down slightly on Friday. And we look at the S&P and compare it to world stocks, we're seeing the short-term correlation getting a little bit stronger. We are starting to flatten out here with our longer-term correlation. So we were down with the 10-year based on yield. We were up with the 10-year based on price. This is still encouraging for the market. When we look at home construction and compare it to the 3 to 7-year bonds, this ratio continues to go up. And this is a very interest rate sensitive part of the market. But when we look at growth to value, not looking all that much better. Qs to S&P, we were sideways with discretionary to S&P, but under the moving average. We're still declining when we compare large cap growth to large cap value. So with the large caps, mid caps, and small caps, we're just not seeing any real strength here. We're back to positive, or I should say we remain positive with the advanced decline ratio based on price. We did dip below 0. That's where we went negative based on volume, and we've been able to come back and turn positive again there. And we're continuing to decline here with the S&P to utilities ratio. It's more positive when that ratio is going up. This ratio is going up, and it's more positive when it's going down, the staples to S&P ratio. And we still have not received the confirmation of the Hindenburg-Ullman. Now, the perma bears, and I don't pay a lot of attention to these folks. I get a few emails here and there, and it's all, rain clouds and lightning bolts and things that seem to come with their emails. They're all saying Hindenburg on the books, going to happen, market falling apart. Well, according to this, we have yet to receive a confirmation. Now, we'll have to see if we end up getting a confirmation. There's a 1-day lag with this chart, but so far it has not happened. And we're seeing a recent spike up here with the NASDAQ Hindenburg-Ullman, but we're still waiting to see if we're going to get a confirmation. Not that that really means much in 2024. We saw lots of confirmations here, but the NASDAQ just kept going up. So what's our outlook? For Monday, we're still looking at earnings season being really strong in the upcoming week. We're still negative with our technicals, but we're back above the 50-day moving average. We're not going to have any economic reports on Monday. And then, just think of how crazy the last 3 weeks have been. And now we have to go through a 2-day weekend. It's like, oh my gosh, what could happen? All right, here is the economic calendar for the upcoming week. The big one is going to be on Wednesday. We're going to get the employment cost index, but then this is when the Fed will make their announcement at 2 p.m. Eastern. We're going to get ISM on Thursday, the manufacturing report, and then we're going to get the big employment report on Friday. And here's a look at the upcoming week and the forecast and what the previous readings were. Seasonally, we're neutral to negative with the Dow and NASDAQ, where we're just flat out negative with the S&P in Monday's session. And we'll be on the 20th trading day of the month, where we do see a little bit of a positive seasonality during an election year for the S&P, and a little bit of a bounce here as we start to finish out the month of July. We're still pretty far away from the all election years taken together. We were getting way above that, and we've pulled back a considerable amount, but we're still above the average. And Monday is the most positive day of the week, though. So then that could be working to the market's favor. And this could be some of the decline that we're seeing here as we're getting ready to go into July. We don't really know. Is it a lame duck president? That's kind of what it's developed into, where a week ago it was the 4th year of a new president. So that's a lot of the political instability that we're dealing with right now. And then the 4th year of a new president, not sure where that applies anymore, but overall, this tends to be positive in July and August and even into September. And here's the presidential election, a bit more choppy than during a non-presidential year. We're finishing up the second half of July, which is a lot weaker than the first half of July. So what are the warning signs? The growth of value, discretionary to staples, they're declining. They're just not really helping the market right now. The 5 and 10-day equity put call ratios are going up. And then our smart money indicator, accumulation distribution, which is no longer extreme. The Chaikin money flow is negative, and the Chaikin oscillator, but it's still extreme negative there. The parabolic SAR is negative, ease of movement, the vortex. We saw the red line cross over there just 2 days ago. But our oscillators are negative on a momentum basis. The ultimate oscillator, Koppik curve, the momentum for the NASDAQ 100 as well as the bullish percent index continues to be negative there. Positive signs, the BPI is above 50 and it's holding up. And our advanced decline line studies, they're looking pretty good now. The S&P and NYSE McClellan oscillators, they're back to looking positive. But with the summation index for the S&P, we're up based on price, we're down based on volume. And the Swenlin trading oscillator, also looking more positive based on price, negative based on volume. The money flow and the bullish percent index for the NYSE, that's actually one of the stronger looking charts that we've seen over the last few sessions. The financial sector is positive as well. So our conclusion, excuse me, our conclusion, we're still negative, but we're back above the 50-period moving average. When we apply it to the S&P, we're negative in the short term. Since we're, oh, I just love this, especially when I get later into the video, especially because we're below the 20-period moving averages. We're not as oversold as we were before. We're negative when you look at all of our charts in the intermediate term, but we're back above the 50-period moving average. So you could technically switch that back to positive, where we're still positive in the long term for right now anyway. So thank you. I hope you have a very good weekend, and I'll be doing all the videos over the weekend, so feel free to check those out. Have a really good time, and I will talk to you in the next video.